I'm a dividend investor, I'm a growth investor, and I am a fund investor. And my goal is to reach financial independence by the time I'm 50 years old. I am 38 now, so that gives me 12 years. Financial independence to me looks like a pot of £500,000. If I have a pot of £500,000, that puts me in a position then where I can decide whether I want to work or not. And my aim is to use this channel to track my progress for the next 12 years to see how I do against that target. From the beginning of my investment journey to hopefully ticking over that 500k milestone at one point. So once a year then, I see it as being pretty important to have a little look through the portfolio, see how it's run over the course of the last 12 months and see if we're actually on track to meet that goal. So in this video then, I'm going to look at how much my portfolio has grown by, how much I've contributed, how much I've made in dividends versus the previous year, and how far off am I from that financial independence number. First place we're going to start with is dividends, because who doesn't love to see their dividends rolling in every month? This is my 2020 dividend return, and it's not the prettiest spreadsheet, I'm afraid, but it's pretty self-explanatory. It's easy to use and it helps me to track things. So across the left hand side, I've got all the businesses that I held. Across the bottom, I've got all the monthly totals in ascending order. I think, did I do it? Not quite. There's one anomalous one there, but generally it goes from lowest to highest paying dividend payer over the course of the year. And you can see it's been ticking up over the months, up and up and up. It is definitely a trend line upwards. So across those individual businesses, total income was £65 over 2020, as well as 90 pence in some funds that I held towards the back end of the year. Brings me a total of £66 and 9 pence in dividend income. Now, this was the first year that I invested into dividend businesses, so I'm comfortable with that. It's good, you know, it's okay. Those returns are okay. It's a great place to start. So let's have a look at how we're doing in 2021 then. So instantly, I know where you're looking straight away. Bottom right hand corner, you're going to see what the grand total is. So £147 and 64 pence. So it's more than doubled in a year. Again, we're not talking serious cash here. 145 quid over the course of a year is not a massive amount of money, but I'm not solely a dividend investor, and my portfolio is only around £4,000 or £5,000 into dividend businesses. So given that, I'm really happy with that. It's doubled. And if it was to double every single year, I would take that, no question at all. What you'll notice on the left hand side is some of the businesses have changed, so we'll go over that in a second as well. And by far my biggest dividend payer over 2021 has been Aviva. So that's brought me 50 quid alone, nearly. So if you watch this channel ever, you're going to know that I'm a pretty big Aviva fan. I've also had some significant growth in that as well. I'm not sure that's going to be sustainable going forward. As far as I'm concerned, Aviva has been one of my best performing stocks that I hold. And I'm getting more from the funds as well, as you can see at the bottom, because I've pushed my funds as hard as I possibly can in terms of trying to get more and more invested into that rather than just concentrating on growth stocks and dividend stocks. I need a fund heavy portfolio for my strategy. So in terms of businesses that I don't have anymore that I held within 2020, I got rid of Coke. All right, so I've kept Pepsi, but I got rid of Coke because I felt like they were too similar and I didn't really need both. It was a bit too condensed in terms of not diverse enough. Also felt it was a little bit pricey and I didn't see really, I know it's a dividend business, but I didn't see any potential for a massive amount of growth in it. I mean, it's a £400 billion business. Also got rid of Procter and Gamble over the course of this year. The reason for that was, again, I felt it was a bit too heavily weighted into consumer goods. So I got rid of that. Really important for me to keep a diverse portfolio. So if I'm too heavily weighted into a certain sector, I'll look at. Next one I got rid of over this year was MasterCard. I got rid of that because I've got Visa. And again, it felt like it was too much into the same sort of sector. Probably the wrong choice there, but I'm going to hold on to Visa for the time being. Another one I got rid of then was AbbVie. And that was really because I kind of naively bought into that. I didn't really know anything about the business. It just looked like a nice dividend. So I don't know anything about the sector too well really as well. So for me, it didn't make any sense to hold an individual business and get such a high level of exposure into that area. So I got rid of AbbVie. And finally, I got rid of Associated British Foods. They cut the dividends. They barely reinstated it. I didn't really see much potential for much further growth in it. I felt like my cash could be put to much better use elsewhere. So I got rid of ABF. And I added 2 businesses over the course of the year, just 2, one of them being legal in general. I did a video on that here, so you can watch that. And another one I added was Unilever. I saw good potential for Unilever over the next few years. Now that for me, that's the total amount of transactions I did over the course of this year, but that alone is too much. It's too much for me. And what I want to be doing in 2022 is less buying and selling. I want to be tinkering less. The more you tinker, the worse your returns. We all know this, but it's a fact. It's been proven. So I want to be tinkering less into the portfolio next year. Next major change over the year was that I finished my Hargreaves Lansdown ISA and I opened a trading 2-1-2 ISA. So I'm just going to have a quick look over the Hargreaves Lansdown ISA and see how that's been performing over the course of the year. So I'm 40% up here on the portfolio now. Haven't contributed anything to it since March time 2021. So it has just been growing on its own over the course of the year. It's grown by about 20% over the course of the year, and the main reason for that is because of this bad boy at the bottom, Tesla. So here we can see I'm 150% up, but I actually bought it much earlier than that. Tesla actually represents the biggest return I've had on any investment. It's around 600-700%. I bought 300 quid's worth in March 2020, which was probably one of the best times to buy it over the last few years, and it has just been storming for me. So it's propped up the whole portfolio. But looking through all of it, you can see the worst returning business I've got is the iShares Japan Equity Index, and that's a 15% return. So I'm still really pleased with this. I haven't changed a single thing in this portfolio over the course of the year. All I've done is open an invest account so that all the fees are going to be coming out of the invest account, and they're not going to be selling off my holdings in order to pay for it. This, as well, as you can see, is where I hold my Aviva stock, where I've had all of those dividends over the course of the year. So those have been invested straight back into the business. I've also, all of my funds are accumulation funds, and those have all been invested straight back into themselves, because that's how accumulation funds work. So we've got just short of £13,000 in here. 3,700 of that is unrealized gains, and so obviously just going to leave that, let that grow and grow. So this is what my trading 2 and 2 portfolio is looking like now. I've got 14,393 invested into here, 5.6% up, a return of 764 quid. I've got invested 13,628. What I really wanted to do with the portfolio is max out my ISA this year. I'm not entirely sure whether I'm going to be able to do that or not. I need to be contributing about 1,800 quid a month between now and the end of the financial year, and I just don't know whether I'm going to be able to do that. So big goal then for next year is going to be to try and max out my ISA as soon as I possibly can. How am I going to do that? Don't know just yet. Is it going to be cut? Is it going to be trying to make more income? Don't know. We'll have to look at that. So we've got 4 pies within here: dividend, funds, growth pie, and new car. So the dividend one, looking at the holdings, as I mentioned before, just 10 holdings in here, but they cover the world. And I've got good returns across here, 13-14% up. The only one that's in the red, I've got 3 in the red. I've got 3M, I've got Visa, we all know why, and I've got Unilever. But nothing that I'm concerned about in the slightest. Most of them are up. Some of these you might call growth companies. Apple and Microsoft, they're still growth companies as far as I'm concerned. They happen to be growth companies that pay a best of both worlds. So we've got 6,400, a bit more than I remember actually, 6,400 invested into here. In my funds pie, I've got a number of different funds that again cover the world. We've got all world, we've got FTSE 250, we've got S&P 500, we've got emerging markets, we've got US biotech. Really is good diversification in there. I've got 4,000 invested in there, just 2% up since April, right? So returns have been bad in my trading 2 and 2 account over this year. It has pretty much flatlined the whole year. I've barely made anything. And that's okay, because I'm not looking at selling this off in the next few months. This is as part of my portfolio to retire on. So the lower it can stay now, the better, because I can be picking up cheaper and cheaper and cheaper businesses, cheaper funds, keep picking them up monthly, dollar cost averaging into them. So I'm completely comfortable. In no way have I done anything to sort of react to the markets being as they've been over the course of this year. It's just the way it goes. It's fine. Actually, it's good. And one of the main reasons the portfolio has struggled so much is this bad boy at the bottom, Virgin Galactic, because back in when I probably opened this, I was just short of 100% up. I'm now 35% down. It has been a car crash over the course of this year. Again, I've done absolutely nothing about it. I've been dripping into it actually, because I believe in the business. I believe in the long-term potential of the business. I'm hopeful that eventually it's going to be the biggest returning stock in my entire portfolio. Within this growth pie, I've added 3 businesses. I've added Alphabet because I sold AT&T. I've added Amazon, and I have added Rolls-Royce. I've done a number of videos on why that's the case. Otherwise, it stayed pretty steady. But again, that's too much tinkering as far as I'm concerned. Finally, I've got the new car pie, and this is a pie that I'm looking to drip into over the course of the next few years, and eventually it will pay for a new second-hand car. That's the plan. And this has been hit pretty hard as well. Total returns on here, 8%. That's all right. It's not bad. Take that. 8% up. And a couple of bad ones there with the clean energy. It's really been smashed to pieces this year, clean energy. And Uber is down significantly as well. Still not making any money. Still unsure about Uber for the long-term returns. To be honest with you, I'm not convinced by Uber at the moment. We'll have to keep an eye on that over the course of 2022. The last one I sold out of in my grow pie was Neo, because I just don't trust that Chinese government. I've explained it before. They can just bring stuff in that just really obliterates a business. If they fall out all over the business, they can just destroy it overnight, and it's too risky for me. Thankfully, I sold out of that at about $50 a share. It's now down at $32 a share, so it's been a real victim of some of these growth businesses that have been hit. Another thing I did this year, which wasn't directly linked to my own personal wealth growth, it is around my free trade portfolio, which I opened in order to try and make a little bit of cash for charity. So it's only got a few $100 in there. It's a bit of a play pot, really. Here's the latest video I did on that if you're interested to see that. But this is just around some businesses that I can potentially look to try and beat the market with. But if you look down the list, oh dear, 43% down, 35% down, 29% down, 12% down, 11% down, 22% down. There's only 2 businesses in there that are in the green, and those are ones that I've bought recently. So growth businesses over the last 3 months have just been absolutely obliterated. So I'm not going to be doing any more tweaking over the next couple of weeks on this, because I'm hoping over the course of the next couple of months that actually some of these growth businesses are going to start returning a bit. Now, thankfully, I am still 20 quid up in here. That is because I sold out of Lucid when it was right at the top, so I've got some good returns from that. But overall, without that, this portfolio will be significantly down at the moment. And interestingly, the S&P 500 has grown over this period. So whilst growth businesses have been destroyed, S&P 500 has grown, and that's mainly because the top 4 or 5 businesses right at the top, the big boys, have just been propping up the whole market. So overall, the portfolio has increased from around 15,000 this time last year to around £27,000 now. Total portfolio across both Hargreaves Lansdown and Trading 2 and 2. So that's a £12,000 increase. But to be honest with you, that's pretty much, there's zero gains in that almost. That is pretty much all around contribution. So I've contributed around £11,000, something like that, over the course of the year into this, and it has barely grown. Like I said before, completely comfortable with that, because it just means I've been picking it up at bargain prices. That's 27,000 versus my target of 500k, which clearly we're miles off still. So, but let's have a look and see what that means in terms of if I continue to drip over the course of the next 11-12 years, what that's going to mean. So this is a calculator site. Everyone loves it. We all know about it. I've put £27,000 in here because that's my opening balance. I'm going to assume an interest rate return of 9%. I'm going to look at 11 years. Because I'm being conservative. I am going to be 39 next year, so at that point it will be 11 years, and I'm going to be depositing around 1,500 quid a month. If I can keep that up over the course of the next few years, if I can maintain the salary that I'm on now, but potentially even grow it, I've actually assumed a 3% growth. So I'm assuming here on the salary I've got at the moment, I'm going to be increasing by 3% every year, in line with inflation pretty much. It's just pretty much going to stagnate it. So if you calculate all of that, that gives me a number of 453,779. So I'm not quite there, and that's fine. About £47,000 off. So there's a bit of a gap I need to bridge, and there's a load of unknowns in here. It's an assumption based on a 9% return over the next 11 years. It could do anything. Christ himself only knows. But it does mean I know and I recognize that I need to try and increase the amount that I'm investing. And one of the ways I'm going to try and do that is try and monetize this YouTube channel. If I can get a few quid out of this YouTube channel, at the moment it's costing me money because of the gear I'm having to buy and the subscriptions, etc. If I can monetize it eventually and potentially make a bit of money out of it, anything I make out of this YouTube channel is going to go towards my financial independence plans. So if you haven't already, hit that subscribe button and help a brother out. I'm going to be doing a separate video on my 2022 targets, so look out for that coming in the next couple of weeks. And if you've just started investing into dividend businesses yourself and you want to see some businesses that I think might have some pretty good returns over 2022, watch this video here. And if you're still here, that means you're one of my favorite viewers that watch right to the end. And I just want to say at this point, I've really appreciated all of the interactions, all of the likes, all of the comments, all of the views, everything from you guys this year. It has been amazing. I've loved every minute of it. I only wish I started this YouTube journey a lot sooner, because I've met some great people. You know who you all are. You're regular people that comment, even the people that watch and don't say a thing. I really appreciate all of your support with that as well. So here's a little treat for you. You get to meet the newest addition to the family. This is Peanut, by the way. He keeps coming into the room. Don't you, buddy? Yeah? You're going to give me a bit of time to do my video now, eh, fella? Yeah?